Good afternoon, everyone. It is January 20th, 2020, and I'm glad to say that finally, after a year, after 3 months of dealing with the intra-election turmoil, that the whole election cycle is finally over, and we can get back to focusing on stocks. So I definitely want to welcome everyone from across the U.S. that are viewing our weekly update this week. And we're certainly excited because, the end of this election cycle could not have come any sooner because it's been a giant distraction for clients, advisors, investors. And for those of you out there that know us, we stay focused on the nitty gritty, right? We get our elbows dirty here, focusing on what really matters, which is investing in specific companies, focusing on disruptors, staying away from the disrupted, and really going long innovation. And the bottom line message this week is that, listen, the sun rose, innovation continued, and the country still exists. America's still the best country on the planet. We are accelerating our economic dominance across the globe, and American companies are leading massive innovation and disruption. It's time to refocus on what matters. And what matters is not just our health, our families and friends, of course, but using our excess wealth to invest in best of breed companies. So the takeaways from this week is that money is cheap and the economy is growing. It's that simple. Don't make it too complicated. Secondly, we do appear to be in the middle of a secular bull market, which was born of the lows of the global financial crisis. We're going to go over what that means from a return perspective and from an asset allocation point of view. Lastly, the inventory and earnings cycle is starting to reaccelerate. Very important point here. We have secular positioning and cyclical positioning. We can have cyclical bear markets within a broader secular bull market, which is really what we had there in March when the market sold off 35%. But right now, we're not only reading that secular bull market, we appear to be still in the early stages of that cyclical recovery. Real quick here on overall returns. We've started 2021 right off where we left 2020. We're up 4.79% here year to date. S&P 500 up about 2.5%, just a couple of points there of outperformance. When we look back to 1-year numbers, 97.3% versus 15.7 for the S&P 500. Going back to inception, 243% returns versus 72 for the S&P 500. How did we do that? We're focusing on the 20% of the index that's leading disruption, that's leading innovation, that has solid and healthy balance sheets. We're discarding the 70% of the index that can really be characterized as companies that are mediocre in nature, treading water, or downright getting disrupted. Right? In this era of disruption, it's so important not just to spread our money around and buy companies that are both good, bad, and ugly. We want to stay focused on best of breed, companies going from good to great. Very important point that we want to remember when we're considering an active management strategy versus an index strategy. This slide is from last week. I just want to, it's the last time we're going to show this slide for hopefully the next few months. But again, doesn't matter which political party is in power in DC. Republican, Democrat, Green, Libertarian, Independent, doesn't matter, right? What matters is companies. What matters is innovation. What matters is disruption. Disruptive secular trends are more powerful than the short-term cycles that occur in DC. Sometimes we'll have a Republican in power, sometimes we'll have a Democrat in power. But none of that changes the broad technological path that humanity is on, and the company's leading that charge. So again, very important point. And that's why we never want to short humanity, right? There's certainly no shortage of reasons to be negative over the last 15 to 17 months. But through it all, innovation has continued. Progress has continued. And what we see here is that the marginal impact from COVID continues to fall. We look at that hospitalization rate for each wave of viral infections in the US, it continues to drop, right? Yes, we got the most cases ever, but the hospitalization rate is falling. That's why you see, despite that rising case count, companies are reopening. The jobless claims number continues to improve despite some short-term blips here or there. Hospitalization rates are down. The economy is growing. Innovation continues. So again, step back from the headlines, ignore the media, stay focused on what matters. Now, probably the most important slide you will watch and read and interpret over the next few years. This is a very important slide. What is this slide telling us? The overall markets tend to trade historically in these 17-year cycles, right? From 2000 to 2008, what we saw there was a secular bear market. But then we entered into a new 17-year secular bull market, according to our work anyway, right? So, the timing could be off by a year or two. But what we see happen is over time, these secular bull markets can go on for longer than a decade, right? So when we look at each time we've had one of these secular bull markets, we've had about a 2,300% return from the birth of that bull market to the final exhaustive peak of the death of that bull market. If we assume a 2,000% return, we get to about 13,000 or 14,000 on the S&P 500, right? And right now we're just approaching around 4,000 on the S&P 500. So again, it sounds crazy, those numbers, but remember how crazy 3,000 on the S&P sounded, how 4,000 sounded crazy. That's what we're talking about when we say the power of compounding, right? And that accelerates during these secular bull market trends. So what could possibly be powering such a powerful secular bull market in the face of such negativity? The obvious being to short the market, to go to cash. So much debt is taking place. Markets trade in interest rate cycles as well, inflationary versus deflationary forces. And what we see here is the end of the last, so when we look at different interest rate cycles, or sorry, inflationary cycles, we were in a deflationary cycle, really, when we kind of look at from 2000 to 2009, or broadly speaking, a few years outside of that, probably 2012, 2013. Now we're sort of entering into this period of reflation, recovery, right? And what started the 1980 to 2000 secular bull market? It was the defeat of inflation. What started the 1950 to 1970 secular bull market? It was reflation, the defeat of deflation, right? So when you get the defeat of structural deflation or the defeat of structural inflation, you tend to get a long-term secular bull market that can run anywhere from 15 to 20 years. This is an important point. It broadly asserts how we think about asset allocation. How risky are stocks short-term versus long-term? When we see this, we're willing to buy, I hate to say the term buy the dip, but we're willing to buy pullbacks in the market in a strategic way, staying focused on best of breed companies within this broader secular bull market. The other thing that really gives us confidence is that stocks are starting to break out of a 3-year consolidation period when we look at stocks versus bonds. Stocks versus bonds had been kind of going sideways for 3 years, and we finally broke out of that channel. When we see that breaking out of that channel, what that tells us is that generally speaking, the relative strength of stocks is improving, and that marginal dollar will continue to flow away from bonds and into stocks. That's where we see the risk right now are in bond prices, not in stock prices. Again, a very important point to remember. And we know that this is not generally looking like 2000, because in 2000, when we were hitting record highs, most stocks at that point had entered into a weak trend backed by weakening short-term momentum. This time, not only do we have a strong long-term trend. In other words, more and more stocks are in are the action, the technical behavior of most stocks is in a positive upward trend, but the short-term momentum is also strong. So most of the stocks are in this top right quadrant versus in 2000, most stocks were deteriorating and in this bottom left quadrant. Again, two separate worlds to be aware of. Now, short term, from a cyclical point of view, from an economic point of view, the earnings cycle is starting to turn, right? What we see here is that things are getting less bad. What's the best period of time to own stocks? Not when things are exciting and great, but when things are getting less bad, when that second derivative is starting to improve. And that's exactly where we're at right now, is that as we get into the back half of 2021, we're actually in the second quarter of 2021, our comparisons are versus last year when the economy was shut down. So do you think earnings are going to be better or worse than they were at the depth of the shutdown of last year? That's how we know from a high level of confidence that things are going to start to get better than expected, less bad. And that's where you want to own stocks, is right at this pivot point when things are getting less bad. And this is what we're expecting right now. The back half of this year, the earnings growth rate is going to go from negative flat to sharply accelerating upward and to the right. Very important. The other big thing is that inventories have been massively depleted, whether it's retail, manufacturers, really kind of across the board, we've seen a huge destocking of inventories. So what that means is, and we can see this here on to the right, is that even though inventories have been destocked, overall retail sales have actually stayed elevated, which at some point is going to force companies to reorder and restock those inventories to meet demand. And we see that in freight rates. When we look at freight rates from China to Europe, those freight rates are skyrocketing. Now, they can be for a whole host of reasons, but generally a recession is not one of those reasons. So the demand for container ships is skyrocketing and prices are following suit. And we know that inventories are depleted, so just a tiny rise in demand will set off a boom in new orders. Again, this is not stuff you're going to read on the cover of your blogs or your magazines or cable news television, because that doesn't sell. That doesn't sell eyeballs. What this does, though, is it helps us create wealth. It helps us make money. And that's what we're here for, is to focus on how can we help our clients make money. We don't really care about the rest of that garbage. It's noise. We don't care about headlines. We focus on what matters the most. And of course, we're still awash in liquidity. We pointed out this chart last week. The annual growth in U.S. money supply continues to skyrocket, and interest rates are at rock bottom levels, like we see here on the right-hand chart. Low interest rates, cheap money, rising supply of cheap money, and an economic recovery. Do stocks go up or down? Forget all the other noise about COVID and politics and everything else. Cheap money, a rising supply of it, and low interest rates and low inflation. You tell me what stock prices are going to do when you hear those points. They likely are going to rise. We could be wrong, but history suggests they will rise. And then lastly, the credit markets remain stable, right? Stable at a very low level. So the cost of credit insurance continues to fall, which again, if we saw something amiss, we would see this turn upward and to the right, but nothing at this point in time. So overall, the big message here is that we believe that based on our homework, based on our research, is that we are in the middle innings of a long-term secular bull market. Money is cheap, inventories are lean. We're in the middle of a secular or cyclical recovery that tends to be good for stocks, right? And credit markets are healthy. So let's not get distracted by politics or the media. Let's play to our strengths. Let's stay focused on best of breed companies that are going from good to great and leading positive disruptive change. Thank you again for all of for your business, for your loyalty, and of course, thank you for all of the feedback that we get on a week-to-week basis. It makes us better. It challenges us. It forces us to think outside the box, and that's what we need, and that's what we want. So thank you again, and have a fantastic and healthy week.